Welcome back. My name is Chris Gosselin from Australian Fund Monitors. Today, the Reserve Bank kept rates on hold as broadly expected by most of the market. With me today to discuss the decision and also look forward into what may be happening in the next 3 to 6 months is Nick Chaplin from Seed Funds Management. Nick, welcome.
Thank you, Chris. Good afternoon.
You were expecting this, so what do you think?
Well, I think this time it was highly, as you say, everyone was expecting it. We were expecting it as well. There's been a history here of them reacting too quickly to information from my perspective. And now you've got the news yesterday that there was some sort of peace deal signed in Iran. And the news was pretty positive for markets. Bonds responded hugely yesterday. The equity market has responded in the US more than it has here. In fact, futures were down here, but the equity market has finished up anyway. But from a bond perspective, it's gone from strength to strength over those few days. So with that recent backdrop, the RBA has gone today probably to almost 100% of expectations and not moved. But they've made some commentary that I think is really interesting. And that is, first of all, one point about the vote today, Chris, it was unanimous. So there was no split. There's been a split the last couple of times. So this is the first unanimous vote for a while. It's also the first time they haven't moved all year. So there's been a move with 3 previous raisings in February, in May, and in April. So now you've got the next meeting on August, I believe it's August 11, so we've got to wait a little bit before the next meeting. And they'll be responding to, in the words of the RBA, that the oil shock is less temporary than they first thought, even though that geopolitical event is tempered. And that, in my impression then, is the ABS going to agree with the RBA and add or maintain the oil shock price increases into the trim mean for CPI? Because if they do that, you have to put a fairly high bet on rates rising in August, because they've come out and probably destroyed any form of comfort that mortgagees are going to get anything in the near term of a rate reduction. And I'm sort of suggesting that may be true. The economy's got some strength to it still. So even though you've got inflationary persistence, you've also got business investments pretty strong, credit's readily available, and labour market measures are remaining fairly resilient. So you've got to think that for the rest of the year, I can't see too many rate reductions, even though banks like CBA have suggested there's no more rate increases this year. And in fact, next year, NAB's even suggesting there'll be rate reductions. So there's a lot of predictions going on, but not a lot of activity this month anyway.
I certainly thought the tone of the comments we're holding now, but hang on for a cut in August. I thought it was more of a wait and see. And next year's a long time away. A lot of mortgage holders are going to be not terribly happy about possibly having to wait for a cut, and it's only possibly have to wait for a cut until next year.
Especially when you think that they're now seeing the oil shock as sort of stagflation rather than a CPI blip of a kind, and consequently, if you get to some point where oil prices naturally do reduce and maintain that reduction over the next, say, month or two, the government probably puts the excise back on and offsets that. And so you still end up with a CPI spike being maintained, and that means the RBA has to chase down CPI and inflation, which means possibly another rate rise. I think people have almost forgotten that excise needs to go back on at some point. The government's not going to give away that revenue forever. And that becomes pretty central to a CPI read in the future, rather than this temporary blip that they're talking about now having gone away, and it's more of a stagflation reality. So I think there's probably more pressure on a rate rise still, and I think the CBA is probably called too early that rates are not going to go up anymore.
We have found out about things over the last 3 or 4 months is that it's a pretty rocky road trying to get towards a peace deal, and Israel certainly doesn't want it. Netanyahu doesn't want it. So there's every chance there are going to be some flashpoints along the way as well, which will upset the apple cart.
I think there's some hawks in the US that probably also believe that the job hasn't been completed. But the broader job there, just getting off financials for 1 second, was to ensure there's no nuclear weapon, which, it seems that that's been the case and part of the arrangement for signing. I haven't read it, but that seems to be the outcome. But there's a lot of people that wanted the regime change as well, and that hasn't come through. So that means that there's still a danger that there's still a tense situation between Iran and Israel, I should say. So,
Nick, just quickly staying overseas, the Federal Reserve, we've got a new Federal Reserve chairman meeting coming up. What do you think is going to happen there?
Well, I mean, you've just seen some pretty big events with the SpaceX IPO and the stock market's booming. It'd be for a number of reasons, tough to see them reducing rates straight away. But I know that there'll be pressure and an expectation even that would be a target, at least from the government. But I think the Fed needs to still hold ground and show responsibility to the economy. And I suspect that the first one isn't a move either way. But I know that there'll be pressure because there was pressure being observed before on the predecessor to reduce rates and make it easier on the economy. But when things are doing as well as they are just at the moment, and they're going through their 250th celebrations as well as we speak, up to 4th of July, it'd be hard to suggest that you need a rate reduction at this point.
Nick, as always, thank you very much indeed. Always good to talk to you and get your wise words of wisdom. We'll look forward to speaking again soon.
Thank you, Chris.